Beijing Tongrentang Healthcare is the largest non-public traditional Chinese medicine hospital group in the country. Their operations are built directly on a 357-year-old heritage. Yet this July 2026 public offering is actually their fifth attempt to list on the Hong Kong Exchange, following 4 consecutive market rejections. To salvage this current attempt, the company slashed its valuation by 25% compared to their failed March offering. That haircut reduced their target capital raise to a maximum of roughly 671 million Hong Kong dollars. A state-backed near-monopoly healthcare brand with 3 centuries of historical weight has been repeatedly rejected by the market, requiring a severe pricing restructure just to complete its listing. We have to ask why. At the midpoint of their new, lowered price band, TONGRENTANGCARE carries an implied post-money valuation of 2.72 billion Hong Kong dollars. Even after applying a 25% discount, that valuation requires investors to accept a trailing price-to-earnings multiple of 86x. To understand how an 86x multiple survives on the open market, we need to look at the free float, the actual volume of shares available for public trading. This equation breaks down the post-IPO share structure. We start with 100% of the company, subtract the 72% tightly held by corporate insiders, and then subtract another 11.2% luffed up by cornerstone investors. That leaves an incredibly restricted final free float of just 16.8%. That 86x premium is insulated by an artificially constrained supply of shares. For anyone buying in, evaluating the business requires looking past the restricted float to audit the underlying operating fundamentals. Inside the company's network of clinics and hospitals, the operational reality presents a clear contradiction. Between fiscal years 2023 and 2025, total patient visits across their network surged by 93.8%, growing to nearly 3.5 million annual visits. This chart maps that 93.8% surge in patient volume against their consolidated revenue. Despite processing nearly double the patients, total revenue remained flat at 1.17 billion RMB. The growing gap between these lines is driven by a severe decline in average spend per patient visit. Nearly 60% of this stagnant revenue pool is tied directly to public insurance payouts. Heavy exposure to national public insurance price controls, combined with steadily rising drug procurement costs, permanently caps the company's gross margins at a low 18.9%. They utilized an aggressive, inorganic acquisition strategy. The primary example is their 2022 purchase of Sangxitong for 284 million RMB. Lacking internal cash to buy Sangxitong outright, TONGRENTANGCARE pledged equity in existing clinical assets, including a 70% stake in Shanghai Sangxitong, to a bank to secure acquisition debt. The outstanding balance on these specific loans still sits at a dangerously high 128 million RMB. When a company pays a premium over the actual book value of acquired assets, the difference is recorded on the balance sheet as an intangible asset called goodwill. In just 4 years of rapid acquisitions, TONGRENTANGCARE's accumulated goodwill exploded from roughly 26 million RMB to over 263 million.
This growth model is not driven by developing new healthcare capabilities. The company is leveraging its existing assets to buy raw patient volume, which has severely degraded the health of its balance sheet. That 263 million RMB in accumulated goodwill poses an existential risk to the firm's equity. This calculation reveals the true weight of that intangible asset. Dividing the 263 million in goodwill by the company's estimated 548 million in net assets yields a ratio of 48%. If any newly acquired clinics underperform, the company must write down that goodwill. This impairment charge destroys net profit, shattering their fragile earnings profile. With margins already compressed and organic revenue stalling, even a minor operational failure will trigger a mandatory impairment. That 48% ratio acts as a ticking time bomb for shareholders. This intense balance sheet stress explains the exact mechanics of their July 2026 public offering. We can see the shifting internal priorities by comparing the intended use of IPO proceeds from the failed March attempt to this July relaunch. This chart details a critical pivot. In March, 47.5% of capital was for acquisitions. 18.9% for debt. In July, the acquisition budget is zeroed out, while debt allocation spikes to 26.3%. Incoming capital doesn't fund expansion. It's consumed to clear past equity pledges. The sponsors have structured this deal using Mechanism B rules, allowing them high levels of control over share allocation. Specifically, the prospectus explicitly waives mandatory retail clawback provisions. This artificially caps the supply of shares available to retail investors, preventing a rapid sell-off. The heavy cornerstone investor locks and clawback exemptions do not indicate strong market demand. They are defensive engineering tactics required to keep the stock from collapsing under the weight of its own debt. We return to the primary tension of the IPO, attempting to justify an 86x PE multiple for a stagnant, highly leveraged operation. Across the broader Hong Kong healthcare services sector, established peers typically trade at multiples between 15x and 30x. This scatterplot isolates TONGRENTANGCARE's 86x multiple, placing it far above the dense sector average cluster. The premium is especially glaring when placed next to their primary publicly traded competitor in the traditional Chinese medicine market, Gushantong. Gushantong operates at 2.8 times the revenue scale of TONGRENTANGCARE, utilizes a highly scalable asset-light model, and consistently delivers double-digit organic growth. Market fundamentals cannot support the premium being asked here. Superior organic growth and cleaner balance sheets are available elsewhere in the exact same sector for a fraction of the price. Tongrentang is a 357-year-old brand with undeniable cultural prestige and a deeply loyal customer base. However, that heritage does not overwrite zero organic growth, a heavy reliance on acquisition debt, and severe public insurance price caps. Any price stability seen immediately after the IPO will be an illusion, maintained strictly by the tight float and cornerstone lockups rather than operational success. Long-term investors must recognize they are not buying into a high-growth healthcare innovator. They are paying an extreme premium to bail out an over-leveraged balance sheet.